Hello, Smart Money Free Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Travis Jamison. How you doing today, Travis?
Yeah, fantastic, Kirk. Thanks for having me here.
Yeah,
Stoked to be here.
glad to have you in the show. Well, for those listeners who don't know you, tell us a bit about your background and what you do.
All right, I've been historically a serial entrepreneur. I've created SaaS companies, marketing agencies, e-commerce products, physical goods, health goods, communities, a little bit of everything, no rhyme or reason. But then after some liquidity events, I slowly shifted to more of like a capital allocator. So now I'm basically a full-time investor who basically invests in the more boring businesses out there.
Nice. So I find that interesting that you made your bread and butter in SaaS, e-com, all those things, and now you're into different industries. What made you want to do that as opposed to just going out and doing the same thing you're good at over and over again?
I think that if someone is building a business from scratch, there's a large argument to be made to do it something related to tech, right? It's cheap to get off the ground. It's easier. You can scale really quickly. But kind of notice that investing in those types of businesses is a very different story. They can be disrupted somewhat easily. 3 years can go by and the technology can change and suddenly it's useless. So I think it's a great place to make money, but to invest, I'm not as convinced. So I would want to deploy my capital that I've earned into companies that have been around for decades and will most likely continue to be around for decades while earning good returns along the way. So that's kind of my strategy, and it's seemed to be working pretty well.
Nice. Yeah, I've seen a lot of I've seen a lot of allocators, people who've had exits, and they'll come back and they'll invest in angel investing, or they'll do the same thing over and over again, or they'll just leave altogether and just invest in passively, and they can focus on other things. Um, what makes you want to keep in the game versus just doing something completely different?
I think the game of like business and investing is probably the most fun game that exists, right?
I agree with
Um,
that.
and the money is nice, but past a certain point, it's kind of just like a points game, right? It's just a fun thing to do. It's what my identity's tied with. I would be kind of lost without it because I don't have anything to replace it, really. Maybe that's sad, but I really enjoy it. And like you mentioned, I tried the other asset classes as well. So I did the angel investing, had like 50 or 60 angel investments. The closer you get to that, the more I don't think it's a great asset class for most people, like venture in general. Um, Besides the, massive illiquidity and like high failure rates, I think unless someone has a very special source of deal flow, they're probably getting the bad deals on average. The large funds, Andreessens, the Sequoias, yeah, yeah, they'll probably do fine. And even them, I'm not convinced they'll continue to do great. That's a different conversation. But for the lonely angel investor who's not well connected in San Francisco, like the chances are pretty low. It's just not a great asset class. And in terms of why not just continue doing it myself, I mean, I am still building companies, but you don't want to have to be grinding 24/7 all the time. Being an entrepreneur is a very, very rewarding personally and financially career path, but it also is a 24/7 gig. Like there's always a fire to put out, there's always something. And so I was kind of trying to figure out along the way, how can I have the returns of small business, which I think are probably like the highest returns out of any asset class? How can I have those returns with having someone else run the businesses and being able to diversify? Because, small business, great returns, the rug can get pulled out of you pretty quickly and you're left with nothing. So how can I diversify between those and have other people operate that? And that's when I kind of searched out.
Interesting. Yeah, it's I mean a lot of things have changed in the last 25 years. Um Small caps used to be a big deal, public companies, and you invest in small caps, great returns. And now small caps aren't going public. Other than the tech companies who are trying to make become large caps overnight, but like small caps are dwindling. Like returns aren't there. Like no one's bringing their I mean, look at SpaceX. Like why didn't that go public? Like
Yeah.
a lot of resistance to companies going public. I mean,
There's no need for it anymore.
yeah, yeah. Like what's the point? Why would you do it? I mean, you get capital, but you get capital in private markets. So what's the
I
point?
was looking at like if you look at the big ones, Stripe, OpenAI, like there's such a robust private market with it that trades all the time. Once a month you can get liquidity and they're trading shares. Employees are doing it. The different venture firms are doing it. It's basically public just to large scale accredited investors and institutions, not to the individual. So a lot of the returns are going there.
Yeah, no, yeah, it's just an alternative strategy to the public markets. I mean, so what I find interesting is you're saying you had like, 50 investments. Like Tim Ferriss went through this. I remember listening to his podcast and how he went through and he was investing in everything and then he stopped. And I know why, because I started down that road a little bit and I was like, you know what, this is eating up too much of my time. Like I don't enjoy it that much. And you got to really put time in. So how do you invest now? Are you just running the company, or are you kind of like an advisor on the board, or like how do you look at it?
I mean, I can summarize my investment thesis fairly simply. On one hand, I invest in a broad spectrum of different ETFs and different verticals and locations and all this stuff to get public market exposure. And on the other end, I'm providing equity capital when entrepreneurs or sponsors are acquiring like a legacy small business. So you can think like a HVAC company, a dry cleaner. I think the last deal that we're closing right now is a kind of a luxury rehab center in the Midwest, stuff like that. Boring businesses, been around for a long period of time, frequently decades. I think our oldest business we closed on is like 70 years old. Been around for a long time, not that competitive, has good returns, and we just provide the equity financing and become a passive shareholder along the way while they run that.
So are you buying out the company, or you're just adding capital to it?
Ah, big distinction. We are not adding capital. The company is being bought out. Frequently, the profile is the founder who started it is retiring, or sometimes the founder's kids are retiring in case of like the older ones. And it's just going to a new owner. And so we're taking that over there.
So is it more like the search fund concept?
It's exactly that.
Okay, all right.
So there's kind of three categories in the search fund concept. The type that a lot of people know of are essentially MBA students from, the top 12 MBA programs. And they raise a bunch of capital and then go search for a couple of years to find a business to buy. And then they come back to the investors and say, hey, this is what I found. Do you want to fund it? We're not really doing that. The two on the other side is one is the self-funded searchers, and that is generally a talented individual searches on his own for a couple years without raising money first. He finds the deal, submits an LOI, it gets accepted, and then he has to go round up the capital to buy that. And so most of the time that'll be partly an SBA loan, and then he comes to investors like me and like my company for the rest of it. So that's one end. On the other side is the term independent sponsors. These are bigger deals, like the deal we just talked about, the rehab center. It's like roughly a $30 million deal. Usually former private equity employees or principals who are went out on their own to do deal by deal basis. So the same thing, they find the deal, they get some traditional debt, and then they start talking to funds, family offices, and people like us to raise the equity capital to secure it.
So you mentioned private equity. I'm curious in your thoughts on private equity right now because I've talked to a lot of people and it seems like it's a little bit past reasonably priced, and it seems like there's a lot of deals and not enough money chasing it right now.
Uh, I think it very much depends on what segment of the market they're in. I generally don't like betting against private equity because I think they're probably the sharpest people in finance. But at the same time, obviously, there was way too much capital, over the last 4 or 5 years, something like that. It got crazy. Valuations got crazy. Anyone who deployed capital in probably 2021, like that fund's probably not doing really well, probably not going to have great returns. LPs are kind of wondering like, where's the liquidity event? There's all these secondary funds, and so that's on the large end. We play like we're basically private equity. We're playing on the like the lower middle market side, and that's where everything's different. So for the large end, you're doing $100 million deal, bigger than that. Maybe you pay 12 times earnings, right? And so in order to like basically a 12 price to earnings ratio, if you're thinking of it in public market terms. And so in order to get good returns, the the PE fund has to really significantly grow that. And maybe they can, but that's a different thing. That's much harder to do. On the lower middle market side, we're buying these companies at 5x earnings and under, sometimes 3x earnings. And so the value proposition changes of like what you need to do to get a good return. If you just keep the company alive, then probably it works out really well. And if you grow it, then it's just, massive icing on the cake. And if you can grow it significantly to where you can get these larger PE funds interested, then you get massive multiple expansion, and it's a home run win. So it depends really on where you're at in the value chain, I would say.
Yeah, I mean, on the smaller side, though, one of the, I mean, what's the size you play in? What do you look at?
The Probably the smallest deal is roughly a $4 million enterprise value deal.
Okay,
Up to 4 million to 30 million is what we've done.
okay, yeah, because I know on the maybe it's smaller than 4 million, it's you can get things a lot cheaper, but it's a lot harder to grow, and you have to get that growth, or else, or you do roll ups. You ever consider doing roll ups? I know a lot of people are doing those right now.
Doing several. We're doing a pool servicing roll up, doing a roll up, which I don't believe I can say because they're trying to keep that niche
It's fine.
private, and a commercial HVAC roll up.
Okay. And you find, and you're able to roll them all together and then get a better multiple for them and sell them. Is that the plan?
Yeah. Yeah, for the listeners that don't know, essentially, if you buy one platform company, like a company that's basically got their stuff together, and then you start buying these cheaper add-ons, roughly 3x multiples, and you combine enough of them together, and suddenly you have an 8x multiple, right? And so everyone just has a massive multiple expansion. Everyone wins.
Yeah. So you don't even need to grow the company. You're just like 3x your money without even growing the companies.
Yeah, yeah. Now, to be fair, that's really hard to do to combine 10 different small
Yeah.
businesses. But that's why they're getting rewarded so highly for that. They get paid for that, but it is hard.
Yeah. Nice. So, all right. So now when you're working with these companies, are you carving out a niche or are you just kind of all over the place with different companies? And you mentioned HVAC and rehab, but like, are you
If
limiting yourself or are you just whatever's out there?
if I was buying these companies myself, I would very much limit myself to a niche that I could completely understand. But as the capital provider, I'm looking to build a diversified portfolio of these boring small businesses. And so I don't want a specific industry. I don't want this industry risk, right? Like take HVAC. HVAC, it's pretty highly priced. Some say overvalued, depending on where you're at. If suddenly the bottom falls out of that industry, which I don't think will happen, but if it does, I don't want that massive exposure. And so I want diversified into everything. Or maybe the tariffs are a great example. Maybe tariffs hit a certain industry, but others they don't. So that's what I'm going for personally. Like my personal goal has always been I want to own 30 different small businesses, different industries, different niches, different locations all around the country. I think consider that a pretty bulletproof portfolio over the long term.
Okay. So how do you manage all that? I mean, I find it hard enough to manage one company, nonetheless 30. So how do you do that?
There's not much to it. All the work is front loaded into seeing if it's a deal I want to be a part of. And then after that, the sponsor, the searcher, whoever bought the company, they are the ones operating it. And we provide support. We provide a fair amount of marketing support to like help them get to the next level because one of my companies is a marketing agency, so we've got a lot of benefits there to help. But for the most part, there's not as much to do. We're just passive shareholders, and they operate the company. They give us quarterly reports, sometimes monthly reports, and that's about it.
Nice. Okay. So you're just providing the financing. So you're going in, these people are running it, they're doing the thing. And you're basically taking, I assume, a majority share.
Depends on, no, I wouldn't say a majority. For the searcher deals that are using SBA loans, we'll never own over 20% of the company. Because we do, we have to personally guarantee that with the
Uh,
SBA, and we're never going to do that. The searchers are doing that, and they're being, very highly rewarded for that personally guarantee. For the larger deals with independent sponsors, they are earning a carry. And so, all the equity checks that are going in are splitting that evenly, um, pro rata. And then the sponsors earn a carry off of that based on some hurdle rates. So they'll can earn anywhere from, 15% carry up to maybe 35%, depending on, each hurdle that they hit.
okay, cool. So let me ask you this, because the trend has quieted down, but I think it was like 2 years ago, I saw a big push from the GPs of selling GP stakes, right? There's always limited partnerships, but it's like, oh, you GP stakes, it's a great thing. And I started looking around, I'm like, why are the heads of KKR selling their GP stakes, and why do I want to be the rube that buys it? So I've just it's just been one of those things. Like when Warren Buffett's selling, do I want to be the buyer? Like so. What's your take on GP stakes and kind of the trends that are going on there?
Well, I have to say, I actually one of those guys that bought some. from a fund. I think they have probably it was one fund, and we got exposure to roughly 10 or 15 different GP stakes. Um, and at the moment, it actually looks really good. But I, like you, am wondering like why are they selling their own? I mean, you could make an argument each way. One, you could say they're trying to get a little bit of liquidity for themselves. Everything's locked up. It's years and years till they get to like eat their carry, essentially. On the other hand, you could say they can see that a lot of these funds aren't going to perform and they're trying to get out what they get is good. You could say either way. I do tend to think on average, a lot of it might be a better bet to buy the GP stakes than the actual funds themselves because they're getting that management fee along the way. And a lot of that's going to pay salary, but not all of it. So
Yeah.
you can make the argument either way. And I don't know that well.
It sounds really, I mean, it's always sounded really attractive. There's that one point of like, why are they selling? And their answer is always, well, just to liquidity, so they can go start more stuff. I'm like, they don't use their own liquidity; they use other
Yeah.
people's. Like, what are you
Yes,
talking about?
exactly.
So it just never sat well with me. I mean, I've seen some great deals, especially in the sports entertainment business. There's some phenomenal stuff out there, and owning certain teams. I'm like, something seems wrong, but I'm not in that space. So that's the kind of thing that I just say, isn't that interesting?
I'm the same. Like even though I kind of play in private equity, we're nothing like the huge funds. I don't know that world. And my co-founder, he does. He's a former principal of a $1.5 billion fund, so he knows that world very well, but I have no idea.
Yeah. Um. All right. Cool. So, um, what is your preference when you're going through these? I know you mentioned you do some roll-ups, but are you trying to expand and grow the business? You mentioned you have a marketing agency. Like, what's kind of is it depend on the deal, or are you just kind of going with the blueprint and say, all right, here's our process that we go through, or how do you do that?
Yeah, it very much depends on the deal. I think the first way to think about these, like almost all investments are looking to get into some asset and then significantly grow it over time, right? Ours, there's these two Harvard Business School professors, Rick and Royce. Be great to have on the show if you can get them. They kind of wrote the book on search funds, right? A lot of people might have read the Harvard Business School Guide to Buying a Small Business. They're the ones that wrote that. And they have this saying, which is in the magic is in the multiple. And that's for this basically the search fund asset class. That because you're buying these so cheap, 3x, 4x earnings, you just have to keep the business alive and everyone wins. Over 4 or 5 years, you've basically paid off the entire purchase price already. And you now have this business kicking off something, 20% a year cash. Like that's pretty attractive. It, if you grow, it just amplifies that massively. And everyone wants to grow. Everyone wins way more if they do, but that's not the initial focus. So when we start going through these companies looking what to do, it's not, is it a growth story or is it another story? It's first thing, do we think this is hard to kill? A business that is hard to kill is like the main focus that we're on. And so we have this like checklist of different things that we're looking out for. And as long as they get that, go through those, then we'll go a little bit deeper into it. Because some of these deals, say, did like a home improvement company deal. We're looking at getting all of our capital back, invested capital back within 3.5 years. And then it's just distributions after that. And that's a really great place to be. Other ones, kind of like the pool servicing roll up, like we're not going to see any distributions for years because they're taking that capital that they're making and reinvesting it, redeploying it into buying more and more. So that one's very much a growth story. There is no one size fits all investment here.
Okay. Um, I know you and I kind of briefly talked about AI before the show. What are your thoughts on AI and how does that play into your strategies?
Personally, I'm using AI a lot for a lot of my wholly owned companies, and I still have a portfolio of wholly owned companies. We're implementing AI into all kinds of things. It's great for agencies right now. But in terms of investing in I take a little bit of a different spin on it. I thought long and hard about, AI is obviously going to change our world, just as much as the internet did. But like, how do you invest in that? And I kind of thought back to like the airline analogy. I think Buffett's talked about this several times, but you take like the cumulative profits of all the airline industry over its entire lifespan, and it's basically negative for investors, right? Maybe if you invested in Delta at a certain time, you've done well, but like overall, it's a negative. And when I look at AI, it seems almost similar in nature. There's insane amounts of CapEx going in here, tons of money flowing in there, but I have no idea who's going to win. Um, and maybe it's a net negative for investors. And so I'm choosing, can I invest in like chip stocks? Do I invest in those trying to get, overall AI supremacy? Or I can take the third angle, which is what I'm doing, and invest in companies that AI doesn't really matter to, which is these boring businesses. Maybe they'll use AI to replace their phone operator with an AI service, or maybe they'll use AI to get customers in the door through a different way. But it's not going to change how a roofer puts shingles on a house. It's not going to change how a plumber changes the pipes, right? And that's kind of the bet I'm doing is the complete opposite direction. Like as Munger always says, invert. So I'm inverting the problem.
Yeah, it's I got an answer for you. You invest in yourself.
Yeah, I'll take that.
I mean, with AI, that's literally like I've been trying to think about this for a long time. It's kind of like in some ways it's like the SpaceX problem. Like if you're going to space, what's the best way to invest? Like you can't. Like and AI is kind of similar. Like you really can't. I mean, Nvidia, great. You can pay 200 PE for Nvidia. Go right ahead. Be my guest. I'll just wait. But it's always the picks and shovels. But at the end of the day, like the benefit of AI is personal understanding and use of it because it can do amazing things now that most people aren't doing. And I met a guy who's doing business similar to yours, and he just basically slapping AI all over it, and he's like, I am just multiplying my growth exponentially because of AI. He takes a little more active involvement than you, I think. So he's more like he buys it personally, and then similar, but it's just, internal. And he's running the business. So it's a little more involved. But the stuff he's doing, I'm just like, holy crap, like that's the way to do it, right? But it's not there yet where people want it to just run everything. It's not quite there, but the implications are huge. I think if you can figure out how to do it, that to me is really exciting.
I agree with you 100%. I think it's like personal leverage. It's easy leverage for each individual to use and for companies. I think specifically small businesses. So a lot of people have said that a lot of the white collar jobs will disappear, and maybe that's true. I don't know. But I like to think it's probably just going to give each employee leverage, right? So you have two companies that are equal. One lays off half their staff for AI. The other keeps fully staffed and gives each employee, 1,000 agents working hard. Who's going to win? Like that company, which each employee has 1,000 agents, they're going to accelerate way past the original one, and the original one will look really good for a few years with far less employee cost. Uh, but over time, the productivity, the growth will be so much larger. We're seeing this in like even my agency. A lot of the services that we could not offer a few years ago, couldn't make the math work with like staffing up. We now can because now the same amount of people can produce so much more just with like leveraging AI. So I think it'd be really beneficial to a lot of small businesses and large businesses as well. But I'm not sure how it'll work out exactly.
Yeah, it's what I find interesting is the discrepancy in AI, people admitting they're using it versus not, and the people who are figuring it out don't want to share. So, like, if you go online to try to find the influencers,
Mm.
uh, they're really not there. I mean, there's some, but like the people who are using it, like you're not seeing them online. Like they're keeping it secret. So I know of some people who are doing some cool things, but the tech isn't there. So it's kind of like it's still. I feel like it's Bitcoin in like 2018. Where you're still using this paper wallet, and maybe you got some
Yeah,
tech you can put it on a Trezor drive or something, but like it's confusing everybody.
I
So
think you
I
know.
I'm curious how with tech companies it's different with service-based business because it's a lot more scalable, but with like a HVAC company. Like, how do you use it with an HVAC company?
Well, I actually had a disagreement with a VC recently, like in a private conversation. They were trying to come into Capital Pad deals. Capital Pad is the platform that I invest out of. And they wanted to be the major investor in a plumbing company because they wanted all the plumbers to wear these special suits to start tracking all of their movements. And they were going to pay them extra to wear these special suits, to tracking all their movements so they could replace them with robots eventually. And I was like, I mean, this sounds really interesting in certain industries, but if you like watched a plumber, like this, I don't think the robots make sense here. Like they're in, awkward, weird spaces. It's never the right time. Nothing's ever the same, and the process itself isn't that mentally taxing. You just kind of got to figure it out. And so the answer is in small businesses, probably not as much. I mean, again, I gave like the AI phone answering service analogy. Like that makes sense. Maybe some chat bots, some little stuff, but this is like around the fringes of it. For like home services, it's not going to replace the actual thing that much. We're doing a lot with the names differ. We'll call it AI SEO to make it easy, but ranking in the LLMs, the AI search engines, and stuff like that. That's working really well. So that's maybe another way that they might use it, but I don't think it's going to replace the main goods, the main offerings that they do.
Yeah. Well, I think in some ways the blue collar businesses are safer from AI, at least temporarily. Um, eventually all the jobs will be taken over by robots and AI, but the blue collar jobs, I mean, robots are not they're nowhere near like we got at least 10 years before you got to worry about that. Although I was saying this on a prior recording, I did see an advertisement by a Chinese company where the robot was doing cartwheels and like it went into this like fit of rage and started throwing haymakers. It was just this weird thing. Like I don't know why you do the same robot doing the same like fighting and doing cartwheels, but it was weird. But the point is I saw that I'm like, wow, like that's amazing. Imagine if it does something purposeful and functional.
Yeah. I mean, I personally think these humanoid robots are super interesting for certain things, but in most industrial settings, like having just a specific robot, like, attached to some beam doing one repetitive task over and over makes way more sense than some humanoid going and lifting stuff and moving it. Like, it's just not very efficient, I don't think.
Well, I mean, I think that's like agents, right? You can have AI do five different tasks. You're going to agent do one task and another agent do another task and just does that one thing and then is good at it. Um, so yeah, I totally agree. So how do you think it's going to change um business going forward? Because I try to digest as much as I can about AI. And I find the views fascinating. Some people are just overly bullish and everything's sunshine and rainbows, and other people think that Skynet is starting. And, it's apocalypse porn. Like everyone thinks it's going to be one thing, but it's really never the extreme. It's somewhere in the middle. So, how do you think the business, I mean, you're investing in a lot of private businesses that aren't liquid. How do you think the business landscape is going to change over the next 5 to 10 years?
Uh, my main answer is going to be I don't really have an idea at all. I don't claim to. Um, I invest in a way that I don't have to. That's kind of the main point. If I was to take a stab at guessing, I would say we've had quite a lot of large technological changes, throughout the last couple centuries. And each one, everyone thought there was going to be like a massive labor problem. Everyone's going to get laid off because, the cars are going to replace the horse drivers and stuff like that. Um, but it's never happened, right? It's always been the opposite. The difference is this time AI is coming so fast, so quickly. What AI is going to look like next year, we can't even imagine. So if I was to guess, I would say there will be a employment dislocation in the short term. And by short term, I mean a few years. Long term, it'll be the same as everything. It won't make a difference. Humans are very adaptable. They'll find other ways to add value to the world. But short term, there might be a little bump. Is basically the way I think about it. And I have no idea what that means for the individual businesses.
Yeah, it's definitely puzzling to think where things are going to go with the speed that it's coming. I mean, I don't think we're prepared for the speed, frankly.
Speed's the problem. Yeah.
Yeah, exactly. I mean, if you think about, if you think about a lot of things, think about semiconductors, right? We went from an age of basically TVs and answering machines for phones to this wonderful world where we have, a an old school mainframe in our pocket and we walk around with it. And the speed of that allowed us to adapt. uh I mean, social media is a problem. It's like when we were kids, you
Yeah.
do something stupid and you figured it out and then it was over. Now it's like ingrained in the internet forever and you never live it down. Like, oh yeah, you're doing bong hits in high school. I'm like, yeah, I was in high school. That was 30 years ago. Like, well, we're not going to give you the job. Like that, it's a different world with different implications and we're not used to it. AI, like people don't even know how it's just like the crypto thing, right? It's like I don't know how this paper wallet works. Like AI, I don't know how it works. Like I was having this conversation earlier today. Uh, the people who construct AI don't know how it works. I mean, to some
At
degree,
all.
they don't know how it works. They can't explain it. How about quantum computing? They invented this thing. They don't know how it works. Where did this thing fall out of the sky? Like how do you not know? But that's
And
what
if you look at it, it changes, right?
Right, but well, yes. I mean, obviously, there's a depth of quantum physics involved. But what I'm saying is that if the people inventing these things don't know how it works, how do they expect you and I to know? How are we supposed to? And how's the world going to adapt to that? I don't know. It's the scary part is the fact that like we can't foresee implications. Like, is it going to be bad if I put all my stuff in AI? Is it going to like now it knows me and it'll hunt me down? Like, I don't know. Like these are things that people don't have a grasp on. So I think that's it's really hard. But anyway, we're off on a tangent on that. Um, so how should people be thinking about? I mean, what you do is really cool. I've always found that kind of part of finance and investing really cool. It's really alluring, but it's not for everybody. So, how should people be thinking about this space in terms of investing? Should they get in it? Should they not? What are the skills they would need to be successful in it? Like, how should people think about it?
Uh, that's a great question. I'm going to try and think it out in real time. I don't have a pre-prepared answer here. One is the bet sizing, right? These investments are illiquid. At the shortest time frame, 3 years, up to more years than that, 6, 7 years type of thing. And some of them, the ones that I personally invest in, they might be indefinite, right? I love to invest in like some plumbing company. It's been around for 30 years, and the person buying it wants to run it for another 30 years and just pay out distributions. Perfect. I don't want to have to him to resell it and me reallocate that. So it depends what you're looking for there. But these are riskier than your S&P because they can go to zero. Uh, it's nothing like venture. With venture angel investing, you know, probably 7 or 8 out of 10 are going to go to zero, right? With these, it's closer to, on average, 1 out of 10 might fail, if even. It can really kind of depends. So the failure rate's a little bit different. The sophistication level is probably a problem for certain people. If someone understands, can read financials a little bit, maybe understands how certain businesses work, they'll have a much better time. People coming in with none of that background might have a tougher time distinguishing which deals to do. Um, One thing that helps on the smaller end is, or on the large, both ends, is that they are getting debt from banks, right? Sometimes private lenders, sometimes SBA backed banks, and they do a certain level of, I don't want to say diligence, that's not the right word, but they have a certain level of requirements for these people to get these loans. And that kind of brings the average up to like a kind of a higher table stakes level than an average like pie in the sky venture deal. Somebody just thinks up a startup, asks for money, and goes. With these, you're having to make the lenders comfortable that this is a good bet to make. And you can't trust the lenders because they're still just bankers at the end. But it's a nice starting place to be like, all right, this company has their stuff together enough that at least the lenders are willing to lend on that. Maybe I can then feel more comfortable taking a deeper look.
Okay. What when you're looking at companies, obviously you have certain things you look for. Like what are the metrics you look for? What are the big picture items that you're trying to pull out and tease and say this is a good deal or not a good deal?
So our main focus is really curation on Capital Pad. Like we get to see the deals come in all the time, and you look at a deal every single day, and then we say no to the mass majority of them because they're not like going through our basically our checklist, and our checklist is not what we do look for; it's what we watch out for. And so the things for those companies are like cyclicality is a big one. Say a construction company, a new build construction company, that might be a great company to own wholly, but to put debt on that is kind of scary because you don't know when those cycles are going to come. Say a lack of developed infrastructure. So might see a company that is worth a fair amount of money, but it's really just like three people at a company. It's not, like a 25 person team. And that's a lot more scary because you got to risk into individuals. Sophistication of the sponsor buying the business. Do they understand cash flow forecasts and working capital and stuff like that? Is what's the actual value proposition of the company? Sometimes you see a company, maybe it's making $1 million a year, right? But it's really just a website and $100,000 worth of SEO that they then get those leads in and sells them out. Do you want to pay $3 million for that company? Probably not. You probably want to instead build a nice website and $100,000 of SEO. Concentration risk is a big one. Is there just a couple of like large customers for the business that if they go away, it all unravels? Again, there's debt, so that really complicates stuff. Is the valuation too high? Non-standard economics, non-standard government, too much leverage, and then probably the biggest one is like too challenging of an industry. Like a lot of times, either maybe we don't can't understand the industry easily, or it just seems like a tough industry we wouldn't be a part of, which just it's just say no. Like we very much take kind of the Warren Buffett approach of just like waiting for the easy swings, and we're comfortable to wait for long periods of times. Like sometimes we'll go 3 months without doing a deal because we're just hanging out waiting for like that easy, like, oh yeah, that seems like a no-brainer. Let's do that one. And so that's kind of what we're looking out for the whole time.
Nice. So that brings up a question. How do you find your deals?
That was the painful part to get started. And when I was just investing individually, this was the thing I was trying to solve with like the platform. Um, they now mostly come to us. Like we've built up a network. We're always talking to different searchers and sponsors. We have the Capital Pad platform itself, and we're advertising to where these people hang out at. And so they come and submit the deals to us, either via email or they come to the platform and sign up as a sponsor and submit the deal that way. That's how we get started.
Nice. Nice. It must be a good place to be right now. Um,
It is a good place to be right now, but it was hard to build that up, right? Because if you're just starting out, you're like, oh, I want to invest in, a laundromat. Good luck. Like, where do you start? How do you go find the people? Like, you can maybe do it yourself to find one to buy, but how do you go find someone else who's buying it to give them equity, capital? Like, it was hard, and so that was the hard part we built up.
yeah, interesting. So all right. So as we kind of wrap it up here, what are some final thoughts you can leave our listeners with of people who are looking to get into the space? What should they be thinking about? Um, what should they know?
So I'm going to actually promote my company, but for a good reason. To be clear, I invest in every single deal that we've done, and I plan to continue that. I put a lot of capital in these deals because I'm very much believe in them, and we're doing all this work to find the deals to do. I get comfortable with them, and I put my own capital in there. If someone's interested in this, like, and you're a accredited investor, you can check us out at capitalpad.com. And it really is a two-sided marketplace where sponsors bring their deals and accredited investors can invest in those. And the reason I am promoting it like this is because I think if someone is interested in these quite boring businesses, it's almost impossible to break into the space if you're new there. You can, but it's going to take a lot of work to get it. And the thing with these types of deals, the thing with all types of deals is you need to be saying no most of the time. So you need a large volume of deal flow, right? If you're only looking at three deals and have to pick a winner, I don't like that math. But if you're looking at 30, 40, 50 deals and pick a winner, that's a lot more in your favor. And a lot of the ones we pass on will probably work out, to be fair. But we're aiming for the ones that we get really comfortable with.
Yeah.
And again, because our metric is it hard to kill? Like that's the main metric, and then we go from there.
I love that metric because I mean, if COVID taught us anything, it was that, anything could kill a business, right? I mean,
Crazy.
I have a friend who has multiple restaurants and clubs in Boston, very successful, notable institutions, and he had like I think a portfolio of like 12, which is crazy because they're all, really expensive. But he's like, yeah, I had to submarine three of them because we couldn't negotiate a deal with the landlords. Like it sucked because they're notable places people were going, but we just couldn't negotiate a deal. I'm like, well, I mean, I wasn't worried too much about him, but like still,
Yeah.
that's kind of a tough place to be.
Clearly, he's fine, and thank goodness he was diversified in there at least, right?
Yeah, but a lot of
But yeah,
places, I mean, here's the funny thing. So in Boston, I don't know if you've ever been, but it's a very heavy Irish population. Um, there's a notable place called the Kinsale and Government Center right across from City Hall in Boston, like right in the center of things, like big Irish pub outside, like just huge place. They closed. I don't know when the last time you've seen an Irish pub close, but if you want to talk about an indestructible business, it's an Irish pub. They closed because of COVID. So, I kind of look at that and say, it's a testament to the fact that, it's you need you need to really be resilient as a business owner.
yeah. And even then, you'll have to diversify,
Right.
right?
Agreed. Cool. Well, I appreciate you coming on the show, Travis, and sharing your wisdom with us. It's been great. I always enjoy these kind of conversations. Where can people find more about you?
If you want to check out the platform, just capitalpad.com, or you can find me, Travis Jamison, on LinkedIn, Twitter. I'm there rambling all the time.
Nice. Awesome. We'll probably have you back in the future. I love these kind of things. So yeah, thanks for coming on the show.
Eric, it's been fun. It's been an honor to be on your show. Thanks so much.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Travis. Really appreciate him coming on the show, sharing his wisdom with us. Now we're into the panel portion of the show where we have our very own Doug Hagren. Hey, Doug.
Hey Kirk, good to see you again. I get you 3 times this week, so I don't know who's more spoiled, me, you, or the people listening. We'll see. We'll see at the end of the week if the ratings go up or down. So
Yeah, we'll find out because I'm on vacation next week. So that's we'll find out. And we also have our very own Diana Perkins. Hey, Diana.
Kirk, thanks for having me back.
Yeah, glad to have you. Well, let's dive right in. So, Doug, what are some of your takeaways from the interview with Travis?
what he's talking about, I thought it was really interesting. I think he's one of the of the many interviews you do. I think there was a calming certainty in the way that he approaches, his vision, and he's aligned with a lot of people are thinking and talking about. I mean, you know me, I pull stuff off of FinTwit and places like social media all the time, and there's a lot of talk about these days about buying boring businesses. But almost in a meme kind of way. Like, hey, you're young, you don't want to work that job, just go out and buy boring businesses, and you'll see a post where someone bought, someone, on the side, compiled a portfolio of like 12 laundromats. And it's always fun. It's funny because, in a way people almost make fun of this as like, oh yeah, just go out and make money. There's actually a pretty funny Twitter I don't know what handle or person out there is called. His name is Chase Passive Income, and it just makes fun of like these ridiculous ways, things, overblowing it. But the fun, there's a truth to that, right? There's a couple names out there where they sell these ideas of buying these businesses, and it's like, well, first of all, yeah, getting 12 laundromats isn't exactly like, hey, I'm gonna do that, I'm gonna split off part of my income off my 150, $100,000 a year salary, and I'm just gonna go out and buy laundromats. It sounds easy, it sounds great. It's not. There is an opportunity there though. We've talked about baby boomers retiring, or eventually passing away, handing it down. Their next generation may have taken it over, like he talks about, but you don't necessarily have the next generation wanting to take it over. So there's a lot of businesses that do not have that family exit strategy, but they're valuable, they're reliable businesses. The one thing that I listen to is he's got these collectives and he's gonna kind of passively own 20%. You've got these search firms that are basically finding them. When this business owner retires, the one risk that I see there is, and he's probably got a better methodology for identifying this, is okay. That's fine. Warren Buffett buys companies and the people running it stay there and keep running it. He knows they're going to be able to continue that business. We're talking about selling a business out, having a firm that you've hooked up with now take it over and run it. I hope they know what they're doing, because that is a massive change that could potentially lead to significant disruption of something that, yes, in itself, at the bottom line, boring, consistent, wonderful, easy. But anytime you have turnover at the top, there's a lot of things that can change culturally. So to me, that's one of the risks that I foresee there in what he does. He seems to have a handle on it, but I didn't get a lot of clarity.
Yeah. Yeah, no, I agree with that. Diana, what about you? What are some of your takeaways?
Yeah, so one of the areas that really struck me was Travis's approach to deal selection. So going back to Warren Buffett, right, is waiting for the right pitch. And they say you're defined by what you say no to. And so I thought it was interesting how Travis talked about, yes, the boring businesses having a large deal flow, so you can be selective, using AI as a strategic filter, if you will. And instead of almost the common school of thought, I'll call it, where a lot of, companies' leadership or investors are looking at companies that are really leaning into AI and leveraging that. Travis, he's doing the opposite. He said, okay, what businesses, one, are hard to kill, and two, won't be affected to the extent of, a normal, benchmark or other industries. So he can have that more predictability moving forward, because we all know that AI, especially Gen AI, right, which is newer, will be disruptive. It has been disruptive. So it's almost a defensive move. So that approach to deal selection, and then the other thing I'll mention is, I mean, private equity. It's such a hot topic. I feel like a theme that's come up time and time again recently is around more and more of those smaller businesses staying private for the flexibility and control, because there are other ways to obtain private funding. And when Travis mentioned that magic is in the multiple, that quote, I thought that was interesting because it's not just in the PE world, right? When you think of any type of investment, you're always looking at what is that break even point where I recover my initial capital outlay. Like, I know in trading, we certainly do that with options trading, stock trading, and are obviously much larger investments like this. So those were two of the areas that really stood out to me.
Yeah, it's interesting. I mean, this area of the search fund. which nobody seems to want to use that name. It's weird. Like I found this area by accident years ago when I was walking around in the angel investor communities and just meeting people and talking to them. And I was fascinated by just angel investing in general. And so in talking to them, they're like, oh, you should talk to so and so. They run a search fund. What the hell's a search fund? And nobody was talking about that. This was like probably 15, 20 years ago. And no one was talking about it. And so I started messing around and getting to know people. And in Boston, there's like this small group of like three guys that just invest, they pool their money together. They hire a CEO and go buy a company and put the CEO in and they run it. I mean, to me, it's just fascinating that more people don't do that. In the search fund concept is I want to say like if you're doing private equity, you're basically investing in the manager's ability to find deals. A search fund, you're kind of using your own ability to hire good people. So it's a different skill set. And maybe no one's good at that, and that's why they don't do it. But but in general, like I look at it and say, this is a wonderful concept, especially you're if you're the MBA that they're hiring to run it, because all you got to do is put together three people and you put together the fund for them. Just say, here's what we're going to do. I mean, to me, it's not a scalable thing that a lot of people do, but I think as you both said, there are some influencers out there with names that are telling people to go buy these ugly businesses, these embarrassing businesses that nobody wants to say they own. But yet they just rake in cash, and isn't that what an investment is? So I find it really fascinating. I love this area. I'm not sure I want to do it, but I love the idea behind it. And I think for the right person, it works really, really well. So, you know, when, what are your thoughts, Doug? I mean, if you're looking at investing, there's so many different areas in the private and the public side in the small company space. You can just invest in small caps. You can invest in private equity. You can invest in venture capitalists. You can do search funds if you can find them. Angel investing. There's all these different areas you could do. Like, how should people be thinking about this with their own portfolios?
Well, I mean, you make a great point. I mean, I think he mentioned at the beginning of the conversation he uses ETFs and some liquid investments as well. And I think when it comes down to thinking about what to do with their own portfolio, it starts with still layering, the simple financial planning concepts. I don't think this is something that you should necessarily get into unless you have an extreme risk tolerance for the variability of that business, things that can happen. I mean, Diana talked about a moat around these businesses, but even those businesses can be disrupted, and he sees that, right? He sees that there is opportunities that even in some of these boring businesses, things can come along and put some of that capital risk, which is why he likes to diversify in a lot of different places. But now you're running into one of the biggest risks that I think you've heard me talk about, Kirk, that is, not recognized by enough people as liquidity risk. It's having the ability to be able to be flexible in control of your capital. Nothing he's deploying here is money that he can easily exit from. Right? This is. I mean, yes, can you turn around and resell it? Yes. Does he talk about combining all of these different businesses? Which again, another risk there is, as he mentioned, getting them to work together under one portfolio that he can then turn from a 3x to an 8x, right? But there's a reason it's an 8x because it's not easy and there's risk there. And the 8x is only going to work if, the timing's right, if there's capital, out there, because you've talked about this as well. We've spent the last couple of years, there's just so much capital out there. There's so much money. The M2 money supply and M3 money supplies are as high as they've ever been, right? So there's just liquidity all over the place. But if that starts to dry up, that means that where he may be making these consolidations, where maybe these business owners are selling out at a great time because the liquidity the next couple of years starts to dry up, he's now bought them at X multiples, which he has already identified. Maybe some areas like HVAC are already a known X multiple, but if liquidity dries up, everything becomes of an X multiple. Everything becomes overvalued until a certain point in which the timing's right again, liquidity's right again, which means it's going to take patience. There's not, and this is something that I think is just got to be, got to critically understand that this is always going to be a long-term investment. This is why many of these are definitely going to be accredited portfolio, accredited investors. I was actually looking while you were talking. There's a number of collectives. Now, these aren't the search firms, but there's a number of collectives that are opening up in every state around, around the country. Some names that that come to mind are things like the Ohio Angel Collective. Minnesota's got like eight, 6 or 8 angel collectives where people, accredited investors can take this money. It's pulled together. There's a 25% tax credit in my state alone in Minnesota for angel investors because it's the angel tax credit for investing in technology startups. So, there's a lot of money that is being deployed on this. And we talked about private equity a couple days ago. This private equity is different than the choking kind that massively, sucks, in debt. But ultimately, all of these types of strategies are strategies that are, I hate to say it, they're just not going to be something that the general public should run out and just do, unless, as I said, high risk tolerance, or they've built enough liquidity to be able to be patient with these. Because I think while the risk reward is there, there's a lot of opportunity, but you're going to have these pieces come together successfully. You're going to have the timing right, and you're going to have to be able to be able to have that money not accessible for X period of time while it's able to do its things. And the last thing before I pass it back, we talk about this boring businesses. It's the waste management of investing, right? Waste management stock has gone through the roof. This is not private equity, but once again, boring businesses, dirty businesses, trashy businesses. I see the people all the time like, oh, I want to do fun businesses. Oh, this will be fun to get into this business and make money doing flowers and this and retail and boutique shops. And yes, I've seen plenty of them be successful. I've also seen plenty of them funded by an external source as almost like a hobby. The boring businesses, there's a lot of money to be made there, and that's why wealth management stock is at all-time highs. So, or not wealth management, waste management stock is at all-time highs.
Yeah, no, it's a good point, Doug. Diana, what are your thoughts?
I would say as an investor, it comes down to your level of risk aversion. So I agree with Doug. It's the timing, it's liquidity, and it's risk. So when we look at angel investing, you're essentially investing in an idea. So you think about what is the success rate there versus venture capital, which, could be startup to, a bit more mature versus private equity, which is, usually more mature companies, which is what our guest is going after. So I think depending on, what level that you want to invest in based on how much risk you want to take in terms of success for that business on a maturity scale, I think that's one really big consideration. Of course, liquidity is a big one. I think a lot of alternative investments, that's going to be a big consideration in terms of getting that capital back. But again, the time frame, there could be a big reward. But do you have one, the funds, and two, for me, it would be the patience, and and three, that time to recover those investments. The other point I want to make is, Doug had referenced the roll-ups, right? So looking at almost, I'll call it like an anchor company, and then finding other companies within that industry to roll up, and then essentially, package deal exit. When you look at that, and I've worked on quite a few M&A deals in my management consulting career, I would say, knowing that industry, understanding the synergies and understanding whether, back office, I mean, we all know the game here, but how once that rolled up entity is put together, moving forward, if it's going to be a sustainable business, what that looks like, what those considerations are. Of course, that's where that 8x, that multiple comes in. But it can be fairly complex, some of the more softer side, if you will, in business. So that's the other, I think, consideration you'd want to take when looking at, hey, this is a really exciting area, but what's really behind the curtain?
Yeah, no, It's an interesting field. I think it definitely has a draw for people to invest in private companies because it's cool. Even if the company's not cool, but it's like, oh, I got this company, it's mine. There's all these different parts of the equation that make people feel good. I mean, it's different from saying I own, the Russell 2000 to I own, this dry cleaner down the street. You can walk by, hey, that's mine. Like that one's mine. It's producing income. And yeah, this other thing produces income too, but this one's mine. So I think there's different aspects that people bring to the table. I've always been attracted to this sort of thing. Because it's really interesting because the returns can be better. Certainly there's more hassle. It's got moving parts and someone needs to manage them. It's kind of like real estate. Right? Real estate's a business. People think it's passive income. It's not. There's nothing passive about real estate. It's a business. It happens to be more passive than like a dry cleaner because you got, inventory, you got all this stuff you got to deal with, but it's just a different kind of business. And I think what I'm still curious as to why more people don't do this. You've got a few influencers out there talking about this all the time, and it's hard to turn down the idea. But then on the other side, I talked to some angel investors years ago, and it's usually people who had a successful exit, made 100, $200 million, and then you're just sitting around with nothing to do. And that can be hard for somebody who's a go-getter and obviously successful enough to have an exit that they're just sitting around. And so a lot of them will like keep their fingers and stuff. They're like, oh, I'll invest like 25 here and 25 there into these different businesses, and I'll stay on the board as an advisor. And just it's more for them to keep their head in the game than anything else. But I think it's definitely harder on the private level for so many ways. Like who's making the decisions? How do you find a good CEO? What if the CEO starts, they start good and then they really screw up, and then how do you get rid of them? And so on and so forth. When you invest in public companies, you don't have that problem. However, in the past, you used to be able to invest in small cap companies publicly, and they used to grow. They're more aggressive. They got better growth than large cap, but that has not been the case for a long time. I don't know if it's because of private equity or what, but it's certainly not because people love going in the public markets. Private equity is booming because there's opportunity there, and yes, they're also leeching off of businesses. Like Doug mentioned a few on our last week's show. You look at all the failures, the public failures that they've had, and they've had a lot of successes too. But the public failures are like, wow, you just took a pretty decent company and just trashed it. And I think you see that from time and again. I know Dunkin' Donuts was a company that was taken over, and then like there was a time where people were wondering if they were going to survive. I don't follow them, so I don't know their financial situation, but they burdened them with so much debt that it was a question whether they'd even survive. And that happens because private equity is smart and they know how to take their profits out early. And but if you're on the smaller side, it really matters. Now, one thing I will say is that if you're a good operator or implementer in the traction book sense of the word, and you can really put together good systems, you can hire well, you're an operator, like you can operate businesses. Some people have that skill. There in the financial advisory world, there aren't many. There's one guy I met. He is just a machine. I don't know how he is as an advisor, but as a business owner, he is awesome. He is amazing to watch. He just knows how to play the whole business like a marionette and makes everything run 110%. And he's got a big staff and does all this. And that's fascinating. Somebody like that, this is great. But if you're not good at those skills, this would be a disaster. You go in and you're trying to tell the guy what to do. You don't even know what you're doing. That happens a lot too. So I think it's selectively a good idea. If you have the right people with the right skill sets, then it can work. But if you just kind of decide, hey, you just kind of romanticize the process and be like, hey, this is great. I get to own my own business. And it turns out that you can't, well, you just burned a lot of money. And even if you can't kill the business, you can certainly lose money. you might not be able to kill it, but if you started making 200 grand and now you're only making 50 grand, well, that's a bad direction. You probably would have been better off putting your money in the S&P 500. So I think it's good to understand what your skills are personally. And, some people do it for the ego. Like I do this, I own this. But I think if you think of it, if you can disconnect the ego from it, just look at it logically and run the business sound, and just put together good systems, keep people happy, and it just plugs away. There are some great businesses out there that I don't know if they're great businesses, but the numbers are fantastic. Like accounting. Accounting, you can get at a high level 1.2 multiple, at a low level you look at 0.3 multiple, and you can run one of those without even being an accountant. You just have to have somebody on staff that does that work. I know somebody, they just bought an accounting firm, I think it was generating like 10 million a year, and they just bought it, and they have accountants there, they're running it, but they're not licensed. They're not licensed to do tax. All they're doing is they own the business. So there's a lot of business that you can do without even being licensed, and that you could probably buy into pretty cheaply. I mean, think of the accounting business. You buy it for anything less than 1x multiple, your first year, you're golden. You're happy. Year two, you're making profits, and whatever the numbers turn out to be. But accounting's a tough business too. I'm not saying everybody should go do that, but you should know that each business has their own nuances, and you need to understand it well enough. If you just decide, well, everyone says buying a car wash or buying, laundromats are good businesses. Yeah. How many people do you know that don't have a washer dryer in their house? Why are you buying why is this person selling the laundromat? We had a guy on the show 6 months ago. He was talking about laundromats. That was his specialty. And he's like, yeah, I almost bought into a deal, and come to find out they were building a laundromat right down the street, which nobody knew about. You just happened to know about it last minute. And he bailed. He's like, this isn't going to work for me. So I think, there's a lot of things that come in that you can't control within a liquid business. So, as we kind of get close to the end here, what else do you think people should be thinking about, Doug? I mean, AI is coming. There's a lot of things that are going to change businesses. Do you think there's a benefit to being in the private space with the rapidly advancing technology like AI or blockchain that may exponentially leverage your returns and whatnot, or it could destroy them? Like, with that unknown, is it worth buying a private business?
Oh, absolutely. I mean, I agree with Travis on this one. I think at the private business aspect of it, AI is only going to make those well-scaled, non-bloated businesses have a better competitive advantage against the resources that major corporations have always been advantaged with. Um, he talked about the use of AI phone service, right? And it's gotten amazing. Call in and it says, like, I'm an AI assistant, but it's able to answer great questions, get things booked. I mean, right there is a huge elimination of power of time and cost. One of the things we look at, and again, depending on what business you're in, um, you're probably going to have sales. Sales is important. Sales is connecting the people with need with what you have and to get that solution. And they've done studies on this. They say if someone is interested or clicks on an ad or wants help on something, the best way to be able to get back to them and get that connection is within the first 5 minutes. Now, here's the issue. We're not all small businesses are not sitting there with call centers in India. I mean, you can certainly outsource them, right? In the middle of the night, when unfortunately a lot of people are on this, they're sitting there clicking and go, "Oh, that's interesting," and they click on it. The office is closed. You can't get back to them in 5 minutes. But guess what? If you use a call center out of the country, you can. But there is, fairly or not, a disconnect when you're talking to someone. A lot of, especially here in America, a lot of people, they hear that different voice and like, there's not a connection. It's not me. We're people. Creatures of habit. We're creatures of relation, right? AI can relate. They're in if you someone calls in from the South, they can get a voice from the South. Someone calls in from New York, they can get a voice from New York. Kirk, hey, you know what? There's only one Boston Mass dialect, right? And you know what? Got to feel like the comforts of home. There's a Cleveland accent. I mean, I live in Minnesota. Do you think there's an accent there? Absolutely. You get that connection, and 5 minutes after they get that, they're booked. That is huge. Okay, we've got an opportunity to scale in so many different areas, especially when these days these larger companies service is getting worse and worse. I mean, the new tech companies, you can't even call in and get help from anybody. Most of the larger companies now are just layers of bureaucratic bloat. So small businesses still in neighborhoods create relationships. There's a reason that buying these things up has value because the names are known at a level in which someone calls up their HVAC service or whatever it is. They know that company. They've been there. And as a small company, you can scale and you can be faster in ways in which large companies have not. Now, do I think you should just go out and willy-nilly buy it and think it's going to be the magic bullet? Absolutely not. And more data is coming out about the investment in AI. Even the large corporations that can invest in it and afford it, the feedback coming from CIOs, and CTOs, Chief Information and Technical Officers, is consistently, we're not really sure how to turn and profit on this. Like the ROI isn't there. We don't know. We believe in it. We can see there's power, but we're not necessarily sure how to make this a profit center. That is a reality. You can get really expensive. AI can still has a lot of clunkiness that can do a lot of things that can actually ruin your business if it's putting out information that's inaccurate, what we call hallucinations, right? I just read that some gentleman ended up in the hospital because he wanted to cut salt out of his system, and one of the AI search firms told him to say, or AI platforms told him to take sodium bromide instead of sodium chloride. Like, ouch, right? So you need to be careful with it for sure. I would certainly not hand over all of your information. I wouldn't hand over your confidential information. I wouldn't put everything out there and use Chat GPT or Claude or a Gemini as, a source of everything where you're putting in very, very private info. But can it help you to scale repeatable things? Absolutely. Is there an opportunity there where small business can be more efficient and more effective? Absolutely. And I think it's going to help to even the playing field. And the last thing that I'll say in our business, financial services business, they've done studies a while ago that these big, bloated, registered investment advisory firms, there's been a lot of data out there to say, you know what? Sure, they can be worth multiples and millions and billions of dollars of money or hundreds of millions of revenue coming in. But who's more profitable? A lot of smaller practices. The single or the dual advisor in an office with a single admin who they have a good relationship. They don't have the bloat of the administration and everything to run those major firms. And so, yeah, but they have disadvantages that those major firms can do in terms of marketing and information output. AI gives you the opportunity to change all that and actually have a better life and make it easier to compete on a scale. And I think that's where it may be more beneficial for small business than it is for large businesses long run in many different ways if it's used correctly.
All right. Where can people find more about you, Doug?
Already. All right. Well, I'm going to tie this back to in our conversation that we're having right now because honestly, we're talking about private equity. We're talking about the capital. We're talking about accredited investors that need to put money in. And here's the thing. In private equity, the best operators know that deploying capital is half the game, and the other half's going to be structuring the deal to manage liquidity risk and maximize ROI. And you wouldn't want to lock up your millions of dollars without due diligence, cash flow projections, and exit strategy. College planning is for an affluent family is absolutely no different. If you've got resources, congratulations. You're already what we call an accredited investor in your child's future. But that status doesn't guarantee a positive return, and without the right structure, you're going to overpay. You're going to take on hidden liabilities. You're going to tie up capital in ways that limit flexibility for decades. So if you structure a business wrong, you're going to kill the business. And if you structure college wrong, you're going to choke off future wealth. You're going to compromise your retirement, and you're going to deliver a return far below what that same capital would have been earned elsewhere. Smart money families, they don't guess, they plan. And in both private equity and college planning, the money isn't made when you write the check, it's made in how you structure the deal. So if you want to approach your child's education like a deal worth doing, with risk managed, capital optimized, and return on investment maximized, visit our website, Mergent College Advisors. That's MERGENT, mergentcollegeadvisors.com. Start the conversation today.
Great. And Diana, final thoughts from you. What should people be thinking about?
Yeah, so two things. One, on the AI front, I'm a big fan of AI. I used to work in this space actually, and I'll just say human plus machine, whether you're a large company, small company. There was an example given in the interview around you can cut 50% of the workforce and see, cost savings in the short term, or you can keep your entire workforce and leverage it with, AI bots or agents or whatever you want to call it and look for those long-term returns. So there are plenty of back office functions that can be automated through AI, obviously chatbots, call routing, summarization. There's so many ways, marketing, that small businesses can leverage AI regardless of the industry. So huge fan. It is the future. And absolutely, I think investing in private equity, if you have the funds, the industry, I'm a green lit on that. The other thing that I'll mention that's top of mind from the interview today is whether it's investing in an HVAC company or real estate. I like to call it, shiny object syndrome. The real edge isn't chasing after whatever is, hot on the market today. My background's in trading, so I see and hear that a lot. I think one of the biggest takeaways and final thoughts for me on this interview is around being selective in your investments, especially if your capital, there's a lot of capital that's going to be tied up for a long period of time. Being selective, whether it is a piece of real estate, a company, private company, or a share of stock. Um, I'm Diana Perkins. I'm the founder of Trading with Diana, Trading Simplified. If you want to learn more or schedule a one-on-one call with me, you can find me at my website, which is tradingwithdiana.com.
Awesome. Well, thanks again for joining us, Diana. Thanks again, Doug, for joining us. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.